Alright, so this is for the subject capital markets, and the topic are risk faced by financial intermediaries. So we have here a flashcard from Quizlet.com. So again, let's go over the following. Major objective of financial intermediaries management. So essentially it's to increase financial intermediaries returns for its owners. And majority of financial intermediaries, banks, they get their funding from depositors, right? The general public. And of course, they want to maximize the returns for them, although essentially those are fixed, right? But for other financial intermediaries like venture capitalists, investment banks, wherein the returns to the owners would depend on the performance of the investments, then they could increase the returns on those investments. But the increased return would be at the cost of increased risk as well, because what do you call that? The concept of risk and return, if you want to get more return, you have to take on more risk, okay? And we will be discussing the different types of risk being faced by financial intermediaries, okay? And then the effective management of these risks determines the success or failure of a modern financial intermediary. Okay, so we have 10. First one is interest rate risk. As financial intermediaries, so they are under the regulation of the central bank. Here in the Philippines, we have the BSP, we have the Monetary Board imposing the prevailing interest rate depending on the economic situation of the country. Okay, it's one of the tools that they have in the implementation of the monetary policy. Okay, so it would affect the financial intermediaries if the central bank imposes a higher interest rate, so that could translate to less borrowers, and with less borrowers, that would also mean less earnings for the financial intermediary. Okay, and then if the BSP decreases the interest rate, so decreased interest rate would mean more borrowers, but the earnings per borrowing is going to be less because the interest rate is lower. Okay, so they're subjected to that, and so there is interest rate risk exposure. Okay. The second one is market risk. As a business, of course, there's competition in the market, and there's a possibility that the customers could, move from one company to another. They could avail their services from one provider to another. Okay, so market risk is about, keeping your customers getting more customers and then retaining those customers. Okay. Due to competition, so again, there's a possibility of losing customers to other businesses. Okay. And then with regards to credit risk or borrowing risk, there's a possibility that the borrowers would not be able to pay off their loans or borrowings. Okay, as financial intermediaries, so of course they are very much involved in that. Majority of their operations are in lending money to borrowers, normally businesses, entrepreneurs, and private individuals. Okay, so there's a possibility that they might not be able to collect from those, from some of those customers or clients. Okay, next we have off-balance sheet risk. So essentially off-balance sheet, what's found in the balance sheet are the assets, liabilities, and equity. So this is off-balance sheet. So this might pertain to risk with regards to revenue and expenses. Normally, those would be affected by inflation as well. The change in the purchasing power of money or currency. With inflation, of course, the sales or the revenue would be affected, and then with regards of expenses in an inflationary economy, that would be increased as well. Okay. Then you have your foreign exchange risk. Financial institutions normally they sell currencies. There's an exchange from Philippine peso to other currencies, especially to businesses doing international trade. So depending on the performance of the peso, depending on the demand and supply, so it could change, and they could buy the currency at a lower amount, and then later they're going to sell it at a higher amount, and that's how they profit from it. But if it's the other way around, they purchase it at a high price and then they sell it at a low price, that could mean losses to them. Okay. Country or sovereign risk. So this would be for what do you call that? Not sure about this one, but if this is about international trade, then there are certain risks involving more on political, economic, and then cultural factors, which could affect the operations of a financial intermediary. Okay, especially if they're going to open a branch in a foreign company. Foreign country. Okay. Next, we have technology risk. So, financial institutions nowadays, they're putting their business online. You have your mobile apps, but there are still banks or financial institutions that don't have an online presence. They do have website. Almost everyone has a website, but when it comes to applications, not everyone has it. And then, transfers, what do you call that, coordination with other banks, so that it would be easier to make transfers. So not all banks or not all financial intermediaries has that. Okay. Next, we have operational risk. This would, be about the operations and there's a risk of success and failure. Okay, so I think this would be more about compliance with laws, rules, and regulations, so that it's ensured that their operations are in accordance with, certain regulations, guidelines, protocols. All right. And then number 9, we have liquidity risk, the convertibility of the assets or the securities that these financial intermediaries own into cash, which would support their operations normally. Okay, and then insolvency. Okay, part of liquidity as well is the ability of the financial intermediary to pay off their short-term loans or short-term liabilities with their current assets, right? And then for insolvency, this is the ability of the financial intermediary to pay off their long-term debts or liabilities with their assets. Okay, so that's it for this one. Just a short discussion on the different risks and then the explanation and how this could affect the operations of financial intermediaries. Okay, these are what they should consider or take note of or monitor, supervise, and of course counteract with certain actions or maybe plan to mitigate the effects of these various risks in their operations, in their financial performance, in the profitability of their businesses. Okay, so that's it for this one. Thanks and